I really think that majority of gains in this market are in, and they could be in for an extended period of time. If you're wondering what's going on in the market, we're going to break everything down in this video from a macro perspective along with the charts. And guys, I would really appreciate a thumbs up and consider subscribing, as I've definitely been losing motivation on making some content here, and a little bit of love can go a long way, definitely. So I appreciate y'all. But as I stated, I thought we had a 4 to 10% downside move. The majority of that move is being made, and I think we could probably have a couple more days, but then there's going to be optimism of Fed rate cuts and for possible new leadership coming into office. So there will be a short-term rally going into the end of September, beginning of October, and then I think there's a lot of risk going after that. So let's get into today's video. We got a tremendous amount of stocks to break down, so I will be getting to work on that as well. So credit card delinquencies are now pushing a 12-year high. What did we learn from the jobs report? The JOLTS showed us that job openings has fell now to the lowest level since January 2021. ADP data showed the lowest monthly growth of private jobs since 2001. And unemployment ticked down from 4.3% unemployment down to 4.2% unemployment. And I think a lot of us are starting to look at this data and starting to scratch our heads here a little bit, because as we can see, the labor markets are weakening, less jobs out on the market. And also we're seeing unemployment tick down, not up, even though we're seeing leading indicators showing us that there's some problems here with the labor markets. Most people are going to think this is a normalization, and that's what it always feels like. It always feels like a soft landing. It always feels like a normalization until mass layoffs start or the consumer can't pay their credit cards, their home loans. And at some point in time, normally something breaks, and that's what causes the hard landing. Right now, looks like it could be clear skies, maybe a little bit of a bumpy road, but I think volatility is actually going to be here for a little bit longer than everybody anticipates. Now, with the recent pullback in the market, we're trading around 26 times earnings, and I do think we're going to have another rally and start pushing closer to 30 times earnings once again, making us overvalued about 30 to 35%. Buffett indicator is flashing red at 129%, and the Buffett indicator is basically just taking total stock market valuation divided by the GDP, when really we should be trading between 60 to 80%, I believe is about where a healthy market lies. Now, if you've been following the channel, I've been recommending more of your contrarian defensive type names. We've talked about things like healthcare, utilities, and consumer staples as kind of being the area we want to be focused on. And I brought up some individual names like Smuckers and Pfizer as two different names that I thought could possibly outperform in a downward market. Two reasons why I thought those companies could outperform. Not only are they exposed to more of your defensive sectors if we go into a later stage cycle here, but also from a valuation perspective, they're trading well below their peer valuation. They pay dividends. And overall, I would say that their company's earnings are pretty predictable at this point in time in the cycle. So a lot of reasons I like those two names, a lot of reasons I brought them up, and they also did hit on my fundamental analysis from price projections. Now, Pfizer, ideally, I'd like to get it below 27. And if you were able to get maybe another look at Smuckers, I would like it between $100 to about $105 a share. Now, with a company like Hormel Foods, that one was always trading for a premium, so I wasn't shocked that we saw the pullback on it. I think valuation on that individual name was a little stretched. It's a very popular name with a lot of dividend investors. So this is a 10-year chart of the S&P 500 monthly chart here, and we can see that this upper band of this channel here, this yellow band here, we've hit our head on this a few times, tends to be a good opportunity to take profits. And from those levels is where we normally get rejected, and we're getting rejected right now. It's clear to see that we're in this very responsive channel, and I think we want to pay attention to this. And so I just drew the bottom line of this channel, or hit it multiple times. We went from a positive configuration now to a neutral configuration. So what we have going on here right now is we have a 1, 2, 3, and a 4 count on the Tom DeMarks to the downside. We are now in a neutral configuration, no longer positive on the 1-year chart. So things are now starting to roll over on the chart. We can kind of look at this as maybe a double top. Now, I'm not going to say it is right now, because I still think there's catalysts to really drive the market back to an upward direction. So I don't think we have many more selling days. Now, we have the rolling over configuration on the MACD, money flows out, and RSI is actually getting pretty oversold pretty quick here. So I do think we'll eventually start tapping out, both from the RSI perspective and the VIX perspective. So maybe we have one more spike in the VIX. We have another 1 to 3% downside move, which would put it in that 4 to 10% move that I was calling back here. And so in my opinion, I do think we'll see some buying coming in around 5,300. Now, this is bearing any sort of major catalyst. And then we have the catalyst of the first rate cut coming in mid-September. And that's where I think you want to still be positioned for a possible rally at that point in time of a few weeks. So we get that move, and I do think we'll get close to pretty much testing this top here. Now the question's going to be, do we sell off past that point and put in a lower low over the next couple trading days? That would be a very, very bearish signal to me. Or do we put in a higher low from that point over the next week, and then we get a nice rally going into the first rate cut, and we usually have a few weeks of rallying after that rate cut, and then at that point in time, I'd definitely be looking at repositioning. As we showed you earlier in this video, consumer is slowing down. Multiple reasons why we're trading at pretty extensive valuations. So there's a lot of headwinds dealing with this stock market, but yet the stock market's going up. And eventually at some point in time, valuation will matter. And that's why we focus on valuations when we talk about individual names. And that's why I also stated that a company like Smucker's when it was selling off and a company like Pfizer when it was selling off could be good names to hide in. When you're comparing them to a 10-year treasury now yielding 3.7%, both of those dividends were over 4.5% at those price projections. And they were also trading at very, very low multiples, meaning that I don't believe that there's a tremendous amount of downside risk to those names. And I also believe that those are two sectors you want some exposure to in uncertain times. We could have a double top in here, or it could be a conventional pullback from that upper channel of that 10-year chart that I showed everybody from the beginning here. And we could put in a higher low if we get some buying pressure with the Fed's rate cut, going into some optimism in the end of the year. I still think we're going to be heading into a high risk period come October, November timeframe. As you guys can see here, I have some cycle brackets up. And so when we look at going into this cycle here around the end of September into the beginning of October is where I think we're going to start seeing some problems. So call it end of September to October. So as we get into mid-September, I think we'll see a little rally here with the Fed's rate cut. As we get into the end of September, beginning October, I think we're going to roll back over. Now, I know for most people, they should just dollar cost average into an index, set it and forget it. But I just wanted to bring some basic charting here that I want to do with you guys. I'm not a professional chartist, but I do lean on charts sometimes when valuations get a little crazy, because if the momentum's telling me to do something, then I have to pay attention. And the momentum is now telling us, hold on here. There might not be a reason to get into this market anytime soon. Because if we go back to the 1-year chart and we draw a line from the recent 1-year lows, the chart is definitely breaking down on multiple time frames here. And this has been a pretty solid support from the 1-year lows. And take a look at what's going on here. We're breaking down, came back up, broke above it, and now we're breaking back down that trend again. And I do think we could possibly hit this yellow line here at 522. That's probably going to be the lowest I think we'll go over the next couple days, which would be another 4 or 5% downside move. That would be an extreme move to me, but it's also quite capable that that's going to happen because we have the 200-day moving average right around there, and this is a buying zone and a support zone as well. So maybe we do get that low, and then we start bouncing back for the Fed rate cut. So it could be a volatile week going into next week. We're starting to see a pretty significant divergence here in the triple Qs. And take a look at this breakdown here, guys. Look at how far the breakdown is on the triple Qs. I definitely think technology is in some trouble here. Technology has really led this rally, and now we're starting to see defensive names put a bid under the S&P 500 while we're starting to see a really bearish signal in the triple Qs. We have a downtrend downtrends formulating here. We broke out of a very, very important channel. And we're getting negative configuration now, and we're starting to break below major moving averages. A lot of things are actually pointing pretty negative to technology. And maybe technology with the Fed's rate cut is going to have that rally and retest this trend line, maybe even break back above it and hit the bottom end of this channel. But it's a clear channel breakdown here, and it's in a clear downtrend, and everything is stating that it's in negative configuration, meaning that technology and the S&P 500 is most likely not leading to newer highs at this point in time. I feel like if technology underperforms, most likely the S&P 500 is not going to be hitting new highs. And that's where the major problem where the S&P 500 is diverging from the triple Qs here. So take a look at this, almost the identical setup when we talk about the 1-year lows, tested that line 2-3 times, retested it another 2 or 3 times. So this is a pretty strong trend line here, guys. then broke down below it, ripped right back up, hit its head on this downtrend that's now formulating here, along with an important resistance point of about 483 on the triple Qs, and is now in negative territory once again. So this band here is going to be a very, very hard resistance point to break out of, that 483. I just don't think it's going to happen anytime soon. Even if we come over here and we say that by the end of September, I think we can rally. And this is wild here, guys. By the end of September, I think it hits its head once again on that, which would be about a 7 point, which would be just under an 8% rally. Hits its head on those two resistance points. And at that point in time, we're heading into October. What did I say about October? You want to be positioned right for October, because I do think we're heading into a high risk period, October, November. So guys, wanted to come on here. I'm not a professional chartist. I literally just look at the charts when things get a little crazy or when companies are selling off really, really bad, and I'm looking for a bottom or a top. So multiple reasons why I use basic charting analysis. I do think it helps to figure out entry points. I think it helps to figure out momentum. And right now, I think the momentum is actually shifting to the downside. Very, 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 very bad momentum, very, very negative momentum in the triple Qs, which is then going to prevent the total S&P 500 and the total stock market to really underperform if we don't have more strength in the triple Qs. But as we saw by that chart, it's breaking down in a channel, which is a red flag. It has negative configuration, which is a red flag. Valuations are high, which is another red flag. But I do think there's one more rally, one more push in this market based off of history of Fed rate cuts when we compare it to the 2007 setup as well. So very, very similar in those aspects. And I probably would not bet against a positive momentum move in this market when we get closer to the Fed's rate cuts. As always, guys, thank you so much for tuning in. We will see you in the next one.